Welcome, everyone. My name is Corinne, and I will be your moderator this evening. I'm excited to welcome Eric Pook, president of Cirrus Consulting Group, and Bob Gray, partner of Gray, Pilgrim, and Associates, as our speaker tonight. They will be diving into the top tax saving strategies for tenants and owner-occupied dentists alike. Before we get started, I would like to take a moment to go over some housekeeping. If you have a question, please type it in the box labeled "Have a Question" as we go through the presentation. This webinar is sponsored by Cirrus, and Schein is not offering CE for viewing this webinar live or on demand. Eric, Bob, welcome, and thank you for being with us tonight. I'll pass on over to you guys now.
Thank you, Corinne.
Thank you. Thanks, Corinne. Greatly appreciated. We've got truly an incredible program for everyone this evening, an incredible special guest. This is one of the most sought-after courses and most watched courses after the fact last year. So it's a privilege to have Bob Gray join us again. If you don't know Bob, you should. Bob is an incredible speaker. We both worked the circuit together with the Henry Schein Dental Business Institute. But Bob, as a member of Gray Pilgrim, really focused on improving the quality of life of dentists. 30 years, Bob has assisted clients managing the practices, in improving financial success, and ultimately planning for the future. Also, Bob has some great stories from being one of the founding members of the Academy of Dental CPAs, a distinguished group of accountants who specialize in the dentistry profession. And Bob, also one of the key instructors at the ADCPA, it's week-long continuing education programs and beyond, which hopefully we can get back to normal one of these days, Bob. But we've got some great components, and thank you so much for joining us.
Thanks for having me.
Perfect. So really, the purpose, process, and payoff for this evening is this. Many of you are back to well beyond pre-pandemic levels of production, collections, and profits, which is fantastic. And the fact that you've weathered all these storms, plus interest rates, plus global economic, craziness, right? The fact that many of you are ending a year very strong is fantastic. So what a great opportunity to start involving Bob to thinking about now, what can I do to minimize tax? What can I do to really think about the future all the way through eventual transitions, including incorporations, et cetera, right? Relocations, right? As Bob says, learn one of the top missed tax deductions. Certainly cost segregations, and as well as Section 179, which we'll be digging into tonight, where there's lots of questions on it as well. Also, really looking at ways of selling and what people are doing these days specifically to minimize tax and do it as efficiently, right? Why sellers are looking to sell goodwill and buyers want the equipment, right? And then also another component is really as it pertains to the lease is I own my building, right? As well as I own my practice. Why, Bob and Eric? Why do I need a lease in between? And why is it important from a tax perspective? Why is it important from a liability perspective, as well as maximizing the value of the building, value of the practice? So we're going to dig in all of that, as well as what type of lease should I really create with myself as I'm my own landlord. So again, truly great to have Bob here, and we're going to run through some fantastic content this evening. We had well over 100 doctors register within the just past few hours, so we look forward to a great event. Okay, now looking forward. Just to get a quick sense of the room, there's a quick poll that should be up in front of you to describe your current situation. So just again, to help customize some content here, be able to get a good understanding to your specific situation. Are you in the stage of planning to open or relocate the practice? Are you contemplating acquiring a practice in the near future, right? Buying, building, etc.? Or are you on the flip side? Have you now realized you've weathered the storm, Bob? I want out, and I want out yesterday, or sometime within the next 5 years. How do I do this without paying a massive tax bill? Number 4 is, you know what? I just want to stay put, ride the storm, renegotiate my lease, and help take advantage of the pretty favorable conditions and increased leverage for many doctors throughout the country, right? Or none of the above. The second poll is, I know a number of you have reached out in advance, but a number of you have requested some help or questions regarding their specific situations. And that's a perfect segue here, that as we start to dig into year-end processes, investments, etc., we've had the privilege at Cirrus of being around now for over 28 years. Was founded in 1994 by dentists, for dentists, specifically to ensure that they had a specified team helping to make sure they weren't taken advantage of during their commercial office lease negotiation. So it has always been, we're the only healthcare specialized tenant representation firm of our kind in North America. This is it. This is all we do. Right. So that gives us a unique opportunity to speak in hundreds of these types of courses today, as well as having done over 13,000 successful lease negotiations. And we have in-house attorneys that are doing dental office lease negotiations day in and day out. We also have those that used to work at the landlord, for the landlord, negotiating against doctors. Right. So really providing a pretty unique opportunity from start to finish. From that perspective is one of the things that Bob and I are really going to be digging into a fair bit tonight is, again, you've got a number of those that are in a leasing situation, right? And many of you that might also own your specific real estate. But as you can imagine, right in the middle of this graph, the dental office lease is incredibly important. And as Bob will say, while it may not be required by law, it is one notch below it. It is so important for so many variety of reasons to help make sure that your real estate corporation is properly separated from your practice corporation. So with that being said, here's some practical examples. So, for the hundreds of you that are on currently, ownership exercise. So these are ones that Bob and I would do in person in West Allis, Wisconsin. We have the privilege of doing it remotely here this evening, but just give yourself on a blank sheet of paper, ask yourself these key questions. Number one is, who owns your building? Is it yourself personally, your spouse personally, or corporation? Right? Therefore, then also, who owns your practice? Is it yourself or is it your corporation? Right? The next big question is, are you paying yourself rent today? And if the next question is yes, how much are you paying yourself in rent? Are you simply, hey, Bob, I only had a low mortgage rate, so you know what, I'm only paying myself a couple $1,000 a month, right? And I'm saving my practice, hundreds of thousands of dollars a year in comparison to what others may be paying in the same situation. In addition to that, a few other components here, and Bob, I might just get you to mute on your side if you can. From that respect also is, how are we tracking businesses? Are you using the same credit card to buy a handpiece from Henry Schein as you are to suddenly fix the roof? And then when it comes to the end of the year, do you have really a garbled set of financials, which, heaven forbid, if something were to happen to you, what's that impact? In addition to that, another key interesting component here is, what type of lease do you have set up? Is it a gross lease? Is it a modified gross lease? How have you structured that properly, right? And really give yourself a rating between 1 to 10 of the state of your estate. All right, for those of you in a leasing situation, not quite as straightforward. And while you might not have the same control, it does give you an opportunity to make sure that you've understood a couple of key components. Number one is, off the top of your head, do you know when your lease expires? Number one. Number two is, do you know when your option to renew deadline is? And I would say that probably 98% of clients that we work with don't know those two dates. If I can part you with one key perspective, is on your phones, add those two dates. The second you pull up your digital copy, it is one of the most components that are forgotten, missed, and if you miss that option to renew deadline, those remaining options become null and void. Some other key questions, right, to be looking at are, number one is, when do you plan to transition, right? Are you going to come to Bob in 5 or 10 years from now and say, Bob, you know what, hey, I want to sell, and suddenly, now you're scrambling because of the tax exposure. In addition to that, you want to think about term and options. Runway is key. That predictability and continuity of revenue becomes critical to looking at it from the buyer's perspective. The buyer wants to know that if they're paying you a $2 million check, that on Monday morning afterwards, after they buy the clinic, the key works, they can walk in, the patients show up, right? And they have a reasonable expectations of producing similar numbers to what you have today, right? In addition to that, the banks, right? The banks will not issue a long-term loan if there's insufficient term on the lease. So don't think for an instant that, oh, well, it'll be great, you know, Bob, if I just run my lease out and then I become a month-to-month tenant at the same time as I look to sell. Might sound great, but at the same time, if you've got a successful practice, look at it from the buyer's perspective, unless they just want to buy charts, right? If they want a turnkey practice, right, that the another 5 or 10 or 15 years worth of term and options on the lease becomes personal. In addition to that, are you personally liable? Have you signed the lease personally or in your corporation? Are you listed as an indemnifier? Which means that, heaven forbid, if there was an issue, not only for rent, but any of the performance of the lease, a landlord could leapfrog and come after you personally, right? And also, you might be shocked to know that even after you sell, you might be continually liable. So through this, let alone demolition and relocation, give yourself a little rating, right? How do you rate yourself on a scale of 1 to 10? All right, so some key things to be important here as we talk about taxes, as we talk about minimizing surprises, let it be at transitions, mid-career, etc. Right? Some key things at a very high level as we think about from a planning exercise is the assignment clause. Do you have the ability to eventually exit the practice? Does the landlord even give you the ability to assign the lease? Right? Some, it says no transfer, meaning that as one of the conditions of sale is typically that the buyer can get financing, and more importantly, that you can assign the lease from yourself to them. Right? What rental rate increases are there? Is there any rates or specific reference to the landlord being entitled to a percentage of the practice sale proceeds, right? Which could also have some unique tax impacts. Surrender the premises. What happens if you are forced to walk away? Do you have to return it to pre-dental condition? And then also from a succession planning, right, is the lease binding to your successors and heirs? And probably 99% are. So from a planning perspective, you might have done all of great tax planning, etc., yet suddenly the lease, right, the lease is a boat anchor around your estate after you pass. There was a devastating example north of our office that a doctor of 43 years of age had built at a beautiful 6-operatory practice. 3 weeks prior to the grand opening, had died due to a massive heart attack. Fully built out practice, no doctor, no patients. Okay. Doctors, how much is that practice worth? Unfortunately, 0. In this case, less than 0, because then the landlord went to the spouse to say, unfortunately, Mrs. Smith, you're now responsible for the roughly $9,000 a month, right, increasing at 4% per year for the remaining 9.5 years on the lease. So for those of you taking notes, in your next lease renewal, etc., having a very well specified dental specific death and disability clause can be worth its weight in gold. In addition to that, right, are you prepared and have you given yourself a personal guarantee? Meaning that in the event of any issues, disputes, or otherwise, right, do you have yourself and anything personally, right, attributed to you? And then last but not least, right, some of the financial terms. You would be shocked to know how many few people just focus on rent, or how many people focus on rent, maybe annual increases, and that's it. Yet there's another 76 other pages of stuff, including common area maintenance, right, TMI components, right, where we can do certain exclusions, or we can limit the amount of annual increases, or we can ensure that we're not paying for fees outside of what benefits us. Let it be, or other scenarios such as capping the annual increase of those common area maintenance. So in this inflationary type of environment, every single penny counts. With that being said, the financials, right? So Bob may speak to some of the financial components of the tax components of these, but really realize that there are so many more valves to this. Base rent is a big one, of course. Annual increase, right? Significant these days, especially many landlords are asking for 7% annual increases over the next 10 years. What a great annuity, Bob, right? CAM we touched on. Fixturing can be important, especially in areas where it could be upwards of a year to build out a practice, get equipment, etc. Free rent, tenant improvement allowance, right? And landlord work. Is it structured properly to be able to handle a build out of a dental practice with the proper plumbing, right? 1 inch, full 1 inch intake plumbing. Is a sewer pipe in the right location? Is it phase 2 electrical to handle all the specific, gear or improved gear that you're adding over time? So good news. Bob and I are going to touch on the tax impacts and the current concerns of each and every one of these clauses, and we've got a 4-hour webinar for you tonight.
Maybe not.
Gets them every time, right? But, truly, these are just a few of the very negotiable components within your lease that can have a massive impact to your business, right? The reason why Bob and I have the privilege of sharing these sort of examples is because we really want to help protect you to, if nothing else, just be aware of tax strategies, aware of some of the red flags that might be hiding within your lease, and more importantly, have a very clear understanding as to what can be done, right? And how to help mitigate those risks, especially with one of your largest assets, your practice. So death and disability is a big one, right? Be cautious. If you are in a month-to-month situation, it doesn't get more risky than that, especially with things like overholding, which you'll see on the left-hand side, which means that the landlord could actually increase your rent by 150, in some cases upwards of 200% for each and every month that you've been month-to-month. And potentially, they could back bill you all the way back to when you became a month-to-month tenant, right? So how do we help to protect our production? How do we help to ensure that we've mitigated our risk and liability? And how do we start to look at the lease through the eyes of the buyer, right? What are they buying? What is that predictability and continuity of revenue? So I really just wanted to focus on one practical component tonight, one part of the lease. And this is the most sought after and requested part when Bob and I are together in Wisconsin, are some of these practical components. So if you're following along, this is in your lease. This is found in about 75% of dental office leases. This is known as the assignment and subletting clause, but it can be under a whole bunch of other different titles. For a quick moment, have a quick read through this and try to identify as many red flags as possible, right? Things that can be concerning to you as the tenant. For the 42% of you that are landlords, right, look at this from you now being a full-time landlord. It can be a great time to draft your lease today as if you're the full-time landlord, even though you're your own tenant, right? Just purely from the optics of it. Imagine selling your practice in 5 or 10 years from now to say, no, look, Dr. Gray, this is exactly the lease that I've had for the past 15 years, and I'm simply assigning it on to you, which can continue on in perpetuity, right? That's so much easier than I'm selling today. By the way, here's a brand new lease, and it's 67 pages. Whoa. Wait a second. This doesn't line up to the financials and what I've been paying for at all. You want to charge me that much more in rent than what you're paying for yourself? Wait a second. Now all the valuation goes right out the window. Okay, so in terms of some of the red flags, did you notice this? In almost every single lease, you cannot sell your practice without the prior written consent of the landlord. Full stop. Did you notice this one? Most do, right? It was great to do an in-person CE course recently. We had the full room filled, standing room only, 35 doctors. Just for asking, right, to sell your clinic. Going to the landlord, you've got the broker, you've got the buyer, the seller, everything's done, the tax planning's done, everything's done to perfection. You finally go to the landlord to say, good news, Mr. Landlord, I'm out, right? I'm selling and we're closing in the next 2 months. The landlord has 3 choices. Number one, the landlord has the option to A, approve, right? Thumbs up, you're good to go. Number two, decline the tenant's request. Or number three, not only decline, but also terminate the lease on the date of the deal closing. Meaning that the landlord is completely free now to go directly to your buyer and imagine what the buyer would do if suddenly the landlord went to them to say, look, how much is the practice worth without the lease, without the premises? I've got the premises. Tell you what, I'll charge you an extra 20% more, right? And you can just sign a new lease with me. Buy the charts, buy the depreciated assets, right? So heart-wrenching, but so important to know if this is in your lease and how much control and what happens when you do ask eventually to transfer the lease, right, as part of your sale. And as we finish this component, right, look at this. Even when you do sell, good news, the landlord has the opportunity to increase rent up to fair market rent or 15% more than what you're paying today. So again, all the financials, the valuations goes out the window when suddenly the landlord has the ability, right, to charge you that much more. And last but not least, should the tenant, you, receive from the assignee, your buyer, right, any income, cash, goods, or any form of consideration, right, in connection with the assignment of the lease. So basically, if you collect any money for selling your practice, right, the landlord deems that roughly 90% of that revenue is theirs and not yours, because how much is your practice worth without the lease? And more importantly, they view that it's their foot traffic, not your blood, sweat, and tears over the past 30 years, is what's driving that value. Right? I can't stress enough, this is why Cirrus has been around for 28 years, to help ensure that these types of components are structured properly in preparation for sale, right? And to make sure that you're protected. And also, last but not least, upon your eventual sale, let's say they do say yes, right, you might also be shocked to know that you will remain personally and or continually liable, in some cases indefinitely. As long as that lease continues to renew, you may remain on the hook as you transfer into retirement. With that being said, Bob and I had over 30 questions on the last webinar. So just as a reminder, that Q&A section of On24 is open. Feel free to ask those questions as we go through. But isn't it shocking that one little clause on Article 67, subsection 3 of your lease could suddenly impact hundreds of thousands of dollars to your practice? What could happen? Inability to sell, continual liability, right? Putting personal assets at risk, all because of something as frustrating as the lease. Right? And one recent case study, right? Here was a doctor at 74 years of age, right, in Northern California, who tried to sell her practice 3 separate times as part of her retirement strategy. Right? Unfortunately, each and every time the landlord said no. Right? The landlord wanted her space. And unfortunately, right, at the 11th hour, she was forced to pick up and relocate, and we moved her 10 minutes north, and we were able to luckily get the landlord to cover 100% of the build-out costs to secure a new tenancy and be able to allow her to sell the clinic. But can you imagine being at the end of a hard-fought career in your mid-70s and being forced to relocate just purely to be able to extract the value and equity from your practice? From that being said, as I pass it to Bob here in a moment, how do we protect ourselves? Number one is start early. Don't fall into the landlord's traps. This is what they teach landlords, which is the tenant lease cycle. What it says here basically is, Mr. Landlord, here's a great way to increase your profitability without a penny of additional spend. And all you have to do is run out the clock. So for the tenant, the best time to re-engage negotiations is typically 2 years prior to expiry. Right? But if the landlord, I'm busy, I'm golfing, I'm traveling, right? Suddenly then it's 12 months. Wow, now we're getting a little closer, right? When, wait a second, 9 months is the option to renew deadline. that if you don't send by a courier or certified mail, etc., whatever it is specified in your lease, if you don't properly exercise that option, those remaining options become null and void, right? And your ability to stay for another 5 or multiple 5 years is gone. Right? So many landlords will wait until not only after the expiry passes, but in some cases 2 or 3 months prior to expiry to say, oh yeah, your lease is coming due. Here's your new rental rates. Right? Here's the increases because, hey, my debt service, my mortgage just went up by an extra 10 grand a month. So unfortunately, I've got to pass on those costs. Sorry about that. Right? And it can be upwards of 18 months to relocate a dental practice today, right? Or more. And these days, we have clients that are paying anywhere from $300 to $400 in the Bay Area right now to build out a new dental clinic. So important to be in the driver's seat, be prepared, right? And to help protect yourself across the board. What to do? Number one is, after doing this for 13,000 lease negotiations at Cirrus, as the only dental specialized tenant representation firm of our kind, number one is get all the information. If you don't have a digital copy of your original lease, as well as any amendments, riders, assignments, exhibits, etc., always helpful to have that in the event of an audit, that here's all the signed documents, countersigned by both you and the landlord. Number two is figure out your long-term goals, right? Bob, when do I want to transition? Bob, what's the best time? How do I make sure that I'm minimizing my tax exposure and have enough money to retire? Number three is have your office lease reviewed for risks. Have it professionally reviewed. If nothing else, just understand where the issues are, what the issues are, and how to protect yourself. Number four is market rents. Oh my gosh, let it be from New York to California. The rental rates, vacancies, comp reports, right? Market rents have changed dramatically. And to know if you're paying at market, above market, well above market, or maybe less, right, is very important prior to going into the negotiations. And number five is figure out that full, carefully choreographed game of chess first, right? But please, tomorrow morning, don't pick up the phone, skip sections 1 through 5 and say, Bob, right, Mr. Landlord, how much do you want to charge me, right, for my next lease renewal? Right? So important to structure that, plan yourself accordingly. Then, right, with certain proper assistance, making sure that all the financials are negotiated to your benefit, right, as well as all the business clauses and liability clauses as well. On that note, as a great appreciation for everyone's time and a compliment to Henry Schein, we waived the fee for our critical dates and risk analysis. So there's 2 quick questions on the poll as we then pass to Bob is, right, now that many of you have flipped through your digital documents and tried to recall when the lease is coming up for expiry, is it a month-to-month situation? Is it, right, due within the next 2 years? Are you in that sweet spot? Right? Or are you pretty close to it? Is it 2 to 5 years? But you know what, Eric, I don't have any options to renew afterwards. So maybe it is time to plan a little early, right? Is it over 5 years? Do you own it? Right? Roughly 42% of you said that you owned, right? Or are you to the stage where you may be a recent graduate or contemplating and a new one and currently don't have a lease? And then from that perspective, you know, to make it easy, there'll be a quick checkbox here to say yes. Right? Happy to take advantage of the complimentary lease review. Right? And this will be able to record it in our system. That will waive the fee and, more importantly, help to ensure that you've got a great understanding of the red flags, what financial risks may be in there today, to look at rental rates, vacancies, comp reports, demographics. Right? It's been pretty incredible that the software we have today gives us rental rates, vacancies, and really a detailed view of the local real estate market, from Duluth, Georgia, to Honolulu, to Key West, and everything in between. Right? Certainly critically important as you're going through the tax planning exercise and as you're contemplating the future. Right? We're happy to work with each and every one of you. On that note, Mr. Gray.
Thank you.
2022 tax planning, October 4th, 2022.
Yeah, so let me just throw in, Eric, really quickly, though. It's so important for the people that do own their own buildings, though, to realize that a lease for them is critical. And it's not just a matter of, the protection. You also want to make sure that you maximize the market rate. You want to charge yourself the most reasonable rent possible in order to maximize the tax benefits. So make certain if you own your own building that you're talking to Eric about having, your own lease, because that's pretty critical. But let me swing into talking about the tax planning for the end of the year here. I need to say, of course, that Henry Schein is not actually offering any tax advice here, but you can contact me, of course, if you're interested. I am Robert Gray. I've been a founding member of the Academy of Dental CPAs, been an instructor, I've lectured all over. I'm really just passionate about dentists being better at the business of dentistry. I've not spent my entire career for that. So I think you'll find that if you look around many of the courses, you'll see that my name's flying around there somewhere. I'm also really passionate about, wine. For many of those of you who've seen me before on these programs, you know that my wife and I love to go out to Napa and chase those elusive 100-point wines. And I'm an adrenaline junkie. That's a 900 horsepower Cadillac CTS-V. So I'm a little on the crazy side. I have to shout out to my friends at the ADCPA as well. I'm proud to be one of the founding members. We're all over the United States. So if you look around, you'll find us anywhere. Go to adcpa.org and you'll find an accountant near you. And these are people that all specialize in the practice of, for dentistry as a specialization, because in order to be a member of the Academy of Dental CPAs, you can't just happen to have a few dentists as clients. You have to actually be in the space. You have to actually write articles. You have to teach at dental schools. You have to do something that shows that you're really separate and apart and that you're passionate about helping dentists. I always say, if your current accountant can't point to tooth number 8 and doesn't know the difference between mesial and distal, you might want to go to adcpa.org and find one that can. Because people say all the time, well, aren't the tax rules all the same? Yes, but if you had an accountant who really knew exactly the kind of deductions and the things that you were looking for, it makes it so much easier to maximize your deductions. So I think that's what it's all about. Tonight, let me jump in because we're going to talk about a whole list of things. But one of the first things on the topic list is just a simple, quick comment I want to make about the PPP loan forgiveness. Many of you, if you're filing extensions and you're right down to the deadline here, or filing your 2021 tax returns, remember that if you had a PPP loan forgiven, that you can actually tax deduct the interest on that even though you didn't pay it. The SBA paid interest to the bank before they wrote that loan off, and that interest just is the same as any other expense, just as the payroll that you didn't really pay for because the PPP loan paid for it. All of that interest can be tax deducted as well. That may be small for some of you, but again, if it's a large enough PPP loan, it can be thousands of dollars. So don't overlook that. We're going to talk at length tonight about the QBI deduction. It's the Qualified Business Income Deduction. In 2018, under the Trump era, we changed the tax rules dramatically. And one of the things they came up with was this 20% QBI deduction. For the qualified people, you can actually just ignore 20% of your taxable income. Take it as a write-off, as if it never happened. We're going to go through some examples. I've got a couple slides to show you tonight because that's really important. Probably one of the more important topics of tonight. So I want to dive down in that into greater detail. I think one of the other things that I see so often, though, is that people have the wrong retirement plan. You need to ask yourself every year as you go into this, what are my goals? Where do I stand right now? How much money do I have? Do I need extra tax deductions? Because so many people, don't realize how many options there really are. If you look at the simple IRA, that's a very beginning level retirement program for many dentists. A lot of young dentists start with that. And I would say that, that typically that maxes out in the $20,000 total contribution range. And if that size shoe fits, that's great. It's for you. The next step up, however, is the 401k. And that particular plan can have as much as a $61,000 contribution limit. Again, a much bigger limit, comes with lots of other potential benefits. The next step up is a cash balance or defined benefit plan. That's $245,000. That's an amazing difference between $20,000 or $61,000. So for doctors who are late in career and catching up on retirement, if they're on average older than the typical employee that's there, those cash balance plans and can be tremendously beneficial for you. So again, just make sure that you've asked yourself the question, do I have the right plan? The other thing is, should I elect Section 179? You know, people think this is just a basic default, that I definitely should take Section 179, but oftentimes it's not true. If I have a practice that has, let's say, a $400,000 net income, and I just bought $400,000 worth of equipment because I bought a whole new building and we completely renovated, et cetera, do I want to take a $400,000 deduction? Well, the answer is no, not really, because getting your income down to zero means that you utilized many of those tax deductions in the 10 or 15% bracket. I would argue that taxes are on sale when they're only 10%. So people that get their income down to zero and paying no tax can cheer and go woohoo, but I think you wasted time, you wasted money. Save those deductions for when you're in the 35% tax bracket. So spread those things out and plan accordingly. Section 179 is not all or one. You can pick the amount of Section 179 that you want to go. I want to talk about that again. I'll show you an example coming up here. Also, when it comes to maximizing just itemized deductions, again, back in 2018, the state and income and real estate tax limit was cut down to $10,000 max on itemized deductions for returns. You know, if you live in a state where there's no state income tax, and a few of you lucky people are, that may be not as hurtful as some of the other ones, but if you're in California, New York, many of the places that have enormous state income taxes, you got clobbered in tax deductions. So one of the things then you have left is that $10,000 plus your mortgage interest, plus charitable deductions and some other small miscellaneous things. Well, maybe you need to plan. So if I'm going to give $5,000 to my charity every year, maybe you say, well, I'll tell you what, I'm going to give $5,000 in December for this year, and I'll actually put another $5,000 in December and tell the charity that's for next year. And then that $10,000 in this one calendar year of charitable deductions boosts you over the limit so you can actually itemize your deductions and take advantage of those. Otherwise, you hit the standard deduction and none of it really mattered anyway. So make sure that you're looking at as maximizing those deductions as well. I want to save time at the end here for lots of questions. I mean, the point of having some free consultants here tonight is you should be able to raise your hand, type in some questions, and find out some things that are interesting to you individually. Let me talk again about the qualified business income deduction. This is really important because the qualified business income deduction is based on the income you have as a sole proprietor or as a partner. It is not anything to do with your W-2 income. So if you're a C corporation or an S corporation, none of the money that you're taking as a W-2 is subject to this 20% reduction. So again, it became critical now for S corporations to plan really carefully. You know, some clients ask me, well, Bob, why should I just stop taking a salary from my S corporation and I'll take it all as dividends? But the IRS requires that you take, what's called a reasonable compensation. And we could go on and on about what reasonable is, but I think if you look at how you might have paid an associate to perform the production and the services that you did, you're probably going to find that that's sort of the measurement that the IRS is going to use against you to say it's the minimum. Some people have also gone to just, to the public websites and said basically what's the average according to the federal stats, what's the average dentist make? Something in the high 180s, 190 on average in some of these surveys. That you might argue that might be the minimum. For many cases, though, people want to try to maximize their pension plan, so they're trying to make sure they get into the $285,000. But again, that's minimizing that 20% tax deduction. Many times the 20% tax deduction would actually be better than maximizing your pension plan when you look at the overall plan. So it's complicated for S corporation owners, but I think you need to really, really look at that and say, where's the sweet spot? How can I maximize that deduction for myself? Because you want to make sure that you balance that, the difference between distributions and W-2 income. And just as a reminder quickly again, that the PPP loan forgiveness had no impact on the QBI because it was completely non-taxable income. I want to talk about Section 179 and bonus. 179 and bonus, if you have to think of them as technically being the same thing. Section 179 is a part of the IRS code that was developed many, many years ago. And it basically says, listen, you have something that's depreciable. In other words, it's going to last for more than 1 year. And so you should depreciate it over time over its useful life. But instead, we're going to let you just tax deduct it as if it was an expense, just as if it was paper or pens or anything else in the practice. That rule has been around for a long time. The problem is that many states do not recognize Section 179. For 2022, the federal limit is $1,080,000. Again, you could buy $1 million worth of equipment and tax deduct the thing entirely in the first year. Again, when I talked about the difference between bonus and Section 179, you have to look at your state and say, does my state recognize Section 179? Because if not, maybe they recognize bonus depreciation. Bonus depreciation was, again, in the tax code, was almost, think of it as the same thing. I can immediately tax deduct this piece of equipment or this investment under the bonus depreciation rules, and that's how I'm going to get my tax deduction. So this is really more state specific than it is a federal rule. For the vast majority of you listening tonight, either one of these might work for you. Again, but think of it as the ability to tax deduct the equipment that you actually purchase. And it doesn't make any difference if it's new or used. It's completely deductible either way. And it must be placed in service before 1/1 of 23 to be deductible. I get this question all the time. So, Bob, what if I write a check on December 30th and I pay Henry Schein for that new piece of equipment and it gets delivered in January? Well, I'm here to tell you that the correct answer to the question is tonight. The correct answer is that is not tax deductible because it had to be actually out of the box, on the floor, plugged in, and placed in service. Didn't have to actually be used. It had to be available for use. That was the critical factor. The reality is, I'm not going to lie, it's a little bit like going 56 in a 55 mile an hour zone. Has anybody ever done that? Yeah. I mean, the problem is that if in fact it was delivered on January the 4th and plugged in and you're later audited, now the truth is the IRS has to go back and actually then say, well, yes, I'm going to charge you tax for that year, but then I have to amend your next year's tax return to give you the credit for it. So it's a lot of work to go through that kind of gymnastics just to take away a deduction, only to give it back in the next year. I don't know how many agents would actually do that. I cannot recommend it. I have to tell you what the right answer is, but I just know some of you out there have heard that, maybe if as long as I write the check, it's okay. I'll leave that up to your own discretion. And again, just realize that once again, there's differences between the states on this Section 179. Let me go into a deeper dive on this whole concept of the QBI deduction, because I don't think people realize how critical and how big of a deduction this really is. Look at the slide that's up here now. In 2022, the QBI deduction for dentists phases out on a joint tax return between $340,000 and $440,000 of income. If you have $440,000 of taxable income, $440,100, you do not qualify for the QBI. And that's, again, pretty important when you look at this example. Let's look at the left column here. It just said, listen, my practice net income was $470,000. I had $29,000 worth of itemized deductions. My taxable income was $441,000, and I did not qualify for the QBI because I'm too high. So my income tax was $103,940 just for federal tax. Now move over to the other right-hand column and say, well, what happened if I bought $150,000 worth of equipment this year? And I chose to write the whole thing off in Section 179. Now my practice net income's down to $320,000. The same itemized deductions, but I get a $64,000 additional deduction because of the QBI. That's 20% of the $320,000. And my tax drops from $103,000 to $42,000. That is a $61,000 tax savings. And remember, That's 41% just in federal taxes. And again, depending on what state you live in, that could be significantly higher. And so I mean, that's a lot of money. I just want to make sure that everyone understands that QBI definitely is complicated. But remember that you got an additional 20% tax deduction on all of your income just because you got your taxable income down below that QBI limit. That was an additional $64,000 tax deduction in that example for free. You didn't have to write a check. You didn't have to do anything. You got a $64,000 tax deduction just because you planned well and got your taxable income down so that you qualified for QBI. Of all the things we talk about tonight, this has the potential to be one of the biggest things. And again, as you go into the end of the year and you're planning on controlling your taxable income, am I going to take bigger write-offs? Am I going to buy equipment? Am I going to do some things this year? Whatever your decision is going to make, look at your taxable income and see whether you might be in that sweet spot where making a decision like this could have that big of an impact on your taxable income and help pay for that piece of equipment. Again, in that example, it was $61,000 in tax savings on $150,000. That's pretty amazing for that kind of an investment. So I just want you to realize the impact of the QBI.
Bob, pretty incredible though.
So benefits apply to all entities. The example that I showed you was an LLC or a sole proprietor. But what about an S corp, or how does it function? Well, you could have done the same thing. Remember that you could have lowered your salary in that example because my taxable income was lower. I could have planned, because I knew I had this big write-off, to balance my K-1 and my W-2 appropriately and still tried to maximize the benefit. Even C Corps can take a benefit from this, because if you know you're going to have a big Section 179, you're not going to get the QBI deduction, but at least you would lower your W-2. Because of this write-off you're going to get on the C Corporation, you don't need to take that much W-2 income and pay all that Medicare and Social Security tax if you're going to create a corporate loss. So again, tax planning obviously is critical, but regardless of what kind of entity you are, what we're talking about here is really important tonight. So make sure you're looking at this as you get into year end. One of the other tax considerations that I find missed quite often is the big deduction when you're potentially relocating your practice. If you look at leasehold improvements, let's say you moved into a new space several years ago, you did leasehold improvements, and now you're amortizing those leasehold improvements or taking tax deductions for them over time. Here's the thing, what happens is when you actually move and you abandon those leasehold improvements, you get a tax deduction for the entire thing all at once because you've left them behind. And my quick example here, let's say you made $300,000 of leasehold improvements in 2011. You've been amortizing it over 39 years. You didn't do a cost segregation study, which we're going to talk about coming up. When you leave the old office, you get an immediate tax deduction of $215,000. And again, when did you need that deduction the most? It's when you probably invested in a new space. You have a lot of cash flow going out with regards to the expansion. So just realize this has a big effect on your decision to make that move, because this tax deduction offers a lot of cash flow to give you the incentive to do it. We talked about that cost segregation study. Let me talk about that again, because I hear very few people that really know what a cost segregation study is. Many, many years ago, the Hospital Corporation of America won a court case against the IRS. The IRS has always said that these commercial buildings need to be depreciated over 39 years. The problem is that many of the things that you buy in a commercial building are never going to be there 39 years from now. You know, the carpeting, the ceiling tiles, so many things are going to be worn out in 39 years. So why would we have to depreciate them over that super length of time? So they fought the IRS and they won. The IRS then came back with a whole list of regulations on how then, if now that we lost, we have to tell you how we're going to make these cost segregation studies work. It requires an engineering study where you actually break the building down into components. What I call is how to turn studs and drywall into Section 179. Because remember, no part of real estate is ever immediately tax deductible, and yet if you do a cost segregation study, you could actually break it down. Here's a quick example. If it was $1 million building, if you had a no cost segregation study, you take about $25,000 over 40 years. I said 39, but you get to half year, the first year and a half year, the last year, it comes out to 40 years till you spread it out. With a cost segregation study, it's easy to come up with 20% of that cost in the 5-year category, which is the sort of thing you can immediately tax deduct. That'll be an $80,000 tax savings in the first 5 years. And again, when did you need that right off the most? It's when you just got a brand new mortgage and a big lump in your throat and you've got this big building project going on. What a great time to have that kind of a write-off. The computations are actually pretty complicated. You know, I want you to know that if this is an analysis, whether you did $1 million building, here's one if you did tenant improvements. So you don't need to own the building. You could actually do a cost segregation study just with tenant improvements. But if nothing else tonight, if you just leave this knowing that here's with a cost segregation study in the green box and here's without. You can break the building down into its components. And that's important because here's an example. Everyone knows what they think that is. But the answer is, well, I'm going to tell you what it is once you tell me what's plugged into it. Because if a computer is plugged into it, it's a computer. And that could be subject to 3-year write-off. If it's a fax machine, it could be 5-year or 7-year write-off. Again, and it's not just the outlet. It's all the wiring that goes back even to the breaker and the part of the building permit cost. That could be a $380 tax deduction right there just for one outlet. The same thing for something like this. This is just a wall sconce. It's only decorative. So it's not structural. So it could be immediately tax deducted. Even all the infrastructure, the wiring, the plumbing that goes to your dental equipment becomes dental equipment. It's no longer a building. So again, you can imagine how quickly all these things could add up as immediate tax deductions. What doesn't qualify is load-bearing walls. And of course, land never qualifies because that's never tax deductible. But again, I want you just to realize tonight that cost segregation is an overlooked tax deduction in many situations. One of the other things that's really critical is timing the cost segregation study. You may say, listen, I built a new building and I have all this new equipment, so I don't really need a tax deduction this year. I've got plenty of deductions. So then wait. The perfect time might be to wait 2 or 3 years. Now that your income is ramped way up and you're allowed to do a cost segregation study in year 3 that would pick up all of the rapid depreciation you could have taken in years 1 and 2. And now, again, knock down your income in year 2 or 3 when you really need it because the practice is now booming based on your decision to make that kind of a move. So, again, it's really important. But remember, you never want to zero out your taxable income. As I said with Section 179, I think taxes are on sale when they're 10%. So you certainly want to make sure you've got $19,000 of taxable income for a married folk. I even say 12% is pretty much on sale. Why not, have at least taxable income of $80,000 and save those deductions for the bigger brackets down the road. I want to leave some time here tonight, but just again, the key takeaways is that the tax planning is complicated. The best way to plan is to start now. Do not wait until April and call your accountant and say, hey, what should I have done last year? It's too late, right? You want to steer the bus now to make sure you get to the outcome that you want to by December 31st. Don't forget the PPP loan forgiveness. I threw that out there as a small item, but choose wisely before taking accelerated depreciation. Again, taxes are on sale when they're in low brackets. So do not use accelerated depreciation to create losses or get your income down to zero. It's wasted. You've wasted some of those deductions in low brackets when you've done that. And you can turn studs and drywall into equipment. It really is with the magic of that cost segregation study. And so writing off equipment makes it much more tax advantageous and helps with cash flow on these new building projects. I'm going to leave my information up here because anybody who has questions tonight, I would encourage you to reach out to me. It's bob@gpallc.net. If you think our firm can help, we'd be happy to help, dentists. We obviously know how in order to do all these things, and we'd be happy to talk a little bit about, tax planning for this particular year, or look back at other tax returns and see if there's ways we could help by amending tax returns to take corrections for some of the things you may have missed in the past. But I want to leave time for questions because this is the critical part of the evening where you get to actually say, hey, we've got the consultants on board. And let's throw your hand up and see. Are there any people out there with questions tonight that I may be able to answer for you?
Bob, there was one
Corin,
comment.
are there any questions in the inbox? So slide 41 was an example of a $1 million building. And basically what this is showing is the actual difference between in the green box, I had the building broken down into components, and the yellow box without. And then it's calculating the actual present value of the cash flow that's generated by that to see what the benefit would be of actually doing a cost segregation study. Many companies that provide these cost segregation services will actually do this as a complimentary service in order to tell you for certain that whether it's worth it. Many times, we see the cost of a segregation study because of the engineering costs could be $6,000, $7,000, $8,000, maybe for $1 million building. But if you can get $80,000 in tax deductions in the first 5 years, I think everyone listening tonight would argue that that's probably a pretty good deal. Because again, the cost of the cost segregation study itself is tax deductible. One of the other questions that popped up here is, what happens if your spouse has high income? How do you decrease QBI? That becomes very difficult because if your spouse has high income, it's based on your family taxable income. So you have to get your spouse to stay home. So I can tell you, there's not much easy way to fix that particular problem. One of the questions said, I did a build out 10 years ago. Can I still do a breakdown for tax purposes as my salary is increased? The answer is possibly. So you can certainly go back 10 years. The question is whether or not the analysis and the cost would be worth it. You have to look at the amount of depreciation you've already taken in that 10-year period and then compare it to what you could have taken and then compare that to the cost of the study. Clearly, when you're out 5 or 6 years, the answer is an immediate yes. Depending on the size of the project you had, depending on how much of it would have wound up in the 5-year category, will answer that question. So there's never a guaranteed answer for that question. The answer is still, it depends. Are there any other questions tonight while you have consultants live and ready to go? Corin, are there any other cleanup things we want to talk about? I think this program is going to be available online afterwards if you want to review it. There may be some other opportunities to look at the program. So I'm sure everyone will get an email to talk about what those options particularly are. But
yes,
I thank you for tonight's attendance, and I hope you guys found it useful.
We truly thank you so much for everyone's time and attendance this evening. Bob's content, as I mentioned, is truly second to none. Bob's one of the foremost speakers, as you can see, right? Every little penny counts. And some of these strategies are obviously because of the specific knowledge of Bob's dental expertise. So again, if you've got questions, again, if you want to talk about your specific situation, we're happy to discuss. We popped this up as a simple check mark, again, for those of you that might have joined late. This is, you're not alone in all of this. There are lots of strategies, and to help ensure that you're properly protected, to help ensure that you've got the right planning. As you can see, incredibly, as Bob mentioned, for just buying one extra piece of equipment gets you into that sweet spot. Could be tens of thousands of dollars of savings and reduced taxes. So again, if you're not getting this type of guidance and advice from your current provider, certainly worthwhile giving Bob or Bob's team a quick call, right, just to get a second opinion as you go through. No different as your commercial office real estate lease. And if it's been a while since you've been negotiating or renegotiation, or quite frankly, have not had anybody give it a significant look, or just to evaluate your lease for red flags and issues and changes, no different. There can be hundreds of thousands of dollars of things that you might not even be aware of. Little tricks of the trade, as Bob was saying, to help ensure that you have the proper protection and expertise from those that do nothing but dental-specific professional services. We appreciate it. Bob, can't thank you enough. It was incredible guidance, lots of great questions. I'll just go back here to make sure that everybody's got Bob's specific contact details. Myself, as you saw at the beginning, but cirrusconsultinggroup.com. We're happy to assist. It is one of my favorite events of the year. There's always some key components that we learned, and hey, why pay more tax than we have to? So Bob, really appreciate your time. Thank you so much. Corinne,
Yes.
you are a star. Greatly appreciated for helping to work through all of this in the background. Hopefully everybody enjoyed it. And thank you to all of those that have attended. And Corinne, back to you.
Yep. Thanks to all.
Thank you both for the wonderful presentation this evening, and thank you all for joining us tonight on this webinar. We did record tonight's webinar, and we'll email the recording out sometime in the next week, so if you want to reference the content, you can always go back. We also would appreciate your feedback via our survey that will pop up on your screen shortly. Thank you all for joining us, and we look forward to seeing you on future webinars. Thanks, everyone.
Good night.
Thanks all. Have a good night.